Hey everyone, how's it going? Today is May 12th, 2023, and I shaved my face last week and I feel a little different. I don't know if it's a good look, I don't know if it's a bad look. So the question for the week, just because I'm super vain, is should I keep this look or should I grow the beard back? Let me know. I just had to post that poll. Let the crowd decide, I guess, right? Anyways, enough about me. This week, we're going to be talking about all the interesting stuff you missed in the fundamentals and the market happening. We're going to talk about this really heavy concentration in about 3 stocks that are essentially driving the market up in a way that I guess is baffling some people. You know, we have all these signs of recession, you know, debt ceiling, all this stuff, and everyone thinks the market should be going down, right? Like, I know inflation's down, but you know, the market just keeps trekking up, and I really think it's all related to the outperformance of essentially 3 stocks, Apple, Microsoft, and Google. And I'm going to break down, why I think that and why I think that's maybe not a good look for the market at large. We're also going to talk about more stuff going on in the world of regional banks, some of the stuff, I guess, that links back to Apple and Microsoft in that vein. We're going to talk about quickie news this week. And really quick, what just broke about a few minutes ago is that Binance is pulling out of Canada. So if you are a crypto Bitcoin trader in Canada, you use Binance, we'll get to what happens there, but essentially you have until September 30th this year to pull all your funds off. All that, so much more. Thanks for tuning in, guys. Give this video a like if you can. It really helps it reach other people that subscribe to my feed. And without further ado, let's jump into it. All right, so I have a chart here that looks kind of interesting. It looks a little bit parabolic. If this was a stock, you'd want to own it, right? This is a ratio chart that essentially compares QQQ, which is the general technology index of the United States stock market. This is like the top 100 or 200 companies in America, primarily focused on the technology side of things. So any tech device app on your phone, if it's a public company, it's probably in this index. This is that, and then it's the ratio of Apple, Microsoft, and Google divided by QQQ. So that sounds super messy. All this chart really shows you is how much of a percentage that those 3 stocks make of the entire index. So how big of a slice of a pie those 3 stocks take. And essentially, if you just look at the chart here, this is showing that, ignore the y-axis on this. I'll give you kind of a number breakdown. But essentially, ever since about 2015, 2017, the size of the NASDAQ that is taken up by Apple, Microsoft, and Google has gone basically parabolic. These 3 stocks have become essentially, the largest, the biggest heavyweights in the entire stock market index. And for better or for worse, essentially whatever happens to Apple, Microsoft, and Google is kind of the outcome of most people's retirement portfolios now. So is that a good thing? It's a good thing if you're an Apple investor. What it essentially means at this point, to break down the numbers, is that 33% of the NASDAQ is these 3 stocks, Apple, Microsoft, and Google. And again, I'm not even adding in Amazon, Facebook. They're also big, but not as big. And then if we look at a more general index like the S&P 500, which is just the 500 biggest companies in America, sort of weighted by industry size, these 3 stocks, again, take up about 17% of that. And so kind of like a small thought exercise to put into place for yourself. In a given year, when you think about how much money you spend, what percentage of your total income is going to one of these 3 companies, Apple, Microsoft, and Google? And if you want, you could throw Amazon in there, but let's just stick with these 3. So whether you're buying a new phone or you're paying for a software subscription, or maybe you're a business and they're taking 30% of your revenue because you have an app on the App Store, or you got Google Drive or whatever, Android, how much money do you think that you're giving to these 3 companies every single year? And then ask yourself, do you think that's proportionate to the weighting they have in the general American stock market? Now, when we talk about market breadth, it's kind of interesting to see different points in history where we've seen similar things, where 3 massive corporations have made up so much of the entire stock market. Back in the old days, General Electric was something like 10 or 15% of the S&P 500, and now it's a tiny, tiny company. Or you look at the Ford Motor Company or some of these blue chip names before the big technology giants came around and were worth trillions of dollars. It was railroad companies or steel manufacturers. And now these are obviously, the biggest drivers of the American economy. They're some of the biggest hirers. They produce so much, GDP per capita in the United States. And they've become basically bedrocks where if they're down, you buy them. And you don't really question it because they will continue to print and print and print money as everyone needs their services and can't really escape them. If you have a computer, you're touching Apple or Microsoft. You all know that. One of the interesting things I find is when you look at Berkshire Hathaway, which is Warren Buffett, arguably the most successful investor, portfolio manager of all time, Apple now makes about 40% almost of his entire portfolio. So, there's no real need to buy Warren Buffett's portfolio. All he does for most of it is just hold Apple stock, and that's where most of the performance comes from. I wanted to figure out how to do this. If we have any chart experts in here who could figure out what Berkshire Hathaway's performance would be without Apple stock, that would be amazing. Because to me, it seems that basically all the wealth he's created for himself and his shareholders in the last 20, 30 years has been because of just passively holding Apple, not really managing a position, continuously adding to it, collecting the dividends. Take that out of the mix, and I don't think he's a relative outperformer. But because he holds 40% of his portfolio in Apple, and the S&P 500 is only like 8% Apple, he's outperforming the S&P 500, and he doesn't really have to do anything. So let's take a little bit of a look under the hood here of why I think this is potentially a bad thing, why all this concentration in 3 specific names is not quite the healthiest thing for the market. I think people have been a little frustrated this year that we have all this news about inflation going down and a little bit of unrest and everything getting more expensive and interest rates going higher, but the market doesn't seem to care. All these traditional things that the market would look at and say reasons for to be bearish, whether it's yield curve inversions, whether it's a looming recession, whether it's high interest rates, the market, if you just look at the plain indexes, has shrugged off. But that's not the case for a lot of other smaller sectors. These things have classically, all the 3 things I just listed, have classically been big weights and big drags on smaller innovation sectors. And even with the general market being higher, it is keeping down some of these smaller industries or mid-sized industries, let's just say, relative to Apple. I saw something the other day that actually showed that the market cap of Apple is bigger than the entire stock market of the United Kingdom. And that to me is so interesting historically, thinking about how, basically the UK was the biggest market in the world for maybe hundreds of years. And now one company eclipses almost the entire value of their public markets. So let's dive into where I'm seeing red flags. So despite the market grinding up, QQQ, all these things, just unstoppable, those top 8 stocks in the indexes, where am I seeing weakness? Where am I seeing, a lack of interest, and where things I think, or we all think, should kind of be if we're expecting a recession? Well, I think first and foremost where you see it is in innovation. And again, ARK Invest, Cathie Wood's hedge fund, they invest in a lot of these kind of like smaller to mid-sized technology companies. But the big difference with them is that they're classified as innovation companies. So these are high growth, pioneering new products, new services. And because of that, they're going to be very volatile. Because of that, they burn a lot of cash. Because of that, they're not paying dividends, etc. This index has basically done nothing this entire year, while the entire stock market, QQQ, has just ripped. So these things are still in a tight range, basically look like they died. They haven't gotten really much higher than where they were in May of 2022. A year later, these things are completely sideways. So zero growth in the innovation category. And this ETF in particular has names like, Zoom Communications, which you might know, Roku, Shopify, lots of these kind of like mid-sized tech companies you're probably familiar with. Another one that I found really interesting is PayPal. This is probably one of the biggest financial services companies. They just announced earnings this week. They didn't come in, super well for them. This company is back at prices it hasn't seen since about 2017. And there's maybe some fundamental reasons behind that, but essentially the stock market's throwing this one out. There was no relief bounce for this company compared to Nvidia, Facebook. And you have some other ones too. Beyond Meat was one of these hot stocks that launched in 2019. They were going to revolutionize everything, in the world of fake meat. That clearly hasn't really broken into the market, so they have their own independent problems. But this is what I would consider a classical innovation stock. They're kind of creating a new category for themselves. A new food category based on technology, and there's a lot of high growth potential. They had all these partnerships, Beyond Meat, chicken nuggets, burgers, whatever. Stock is at its lowest point ever, just hit all-time low this week on, again, less than stellar earnings. XBI, which is biotech, this is genomics, this is medical engineering, companies in that space. This sector, again, basically flat since 2018, lower actually than it was in 2017. Had that big run up during COVID, like most things crashed during 2022, has not made the same recovery as Apple and Microsoft and all of these innovation companies. Another one here, and again, maybe don't consider it an innovation company, but it is a growth company. Airbnb also, they're a bit more in the services tourism sector. I'm sure that they're getting hit with inflation. People not wanting to go out and spend $250 to stay in someone's basement for one night. But again, I would consider them an innovation stock, right? High growth market, more and more people growing into this space. And again, getting clobbered this week as well. So these are all just a small picture of the divergences that I think are starting to kind of place themselves, and a big reason why you're seeing Apple, Microsoft, and these kind of blue chip brand name companies essentially suck up all the capital. Investors, whether or not you think we're going to a recession or not, it's very clear that investors are consolidating into what they see are the safest names. And that's why these innovation stocks cannot get a bid to save their life. They just have gone nowhere in the past year, while Apple, Nvidia, all these things on, the cutting edge of AI, but also having this moat of, really good cash flow and billions of dollars of quarterly sales and all this stuff that we know is tried and true. All the money is going to them. All the passive funds from pensions, from 401k savings, it's all just going into these big ones. And it has this roll-on, knock-on effect, because let's just say you're a pension fund manager. You're not going to buy an index stock. You might just buy the underlying ones. And when you look at the proponents and the holdings, you see 50% are just 10 stocks. So just buy those 10 stocks and move on. Have a tiny little sliver where you put it into some innovation, but don't take big risks. Why do you need to, right? So yeah. That's kind of my point. But what are the long-term ramifications of this? Well, I was trying to find a quote here. So number one of the problems with the stock market and our tendency to kind of really concentrate in these big winner stocks is that essentially those business models are much different from the innovation companies. The innovation companies are taking every single dime they can get, investing it into new research projects, new products, taking risks, trying new things. And meanwhile, all the money that flows, all the free cash flow that flows into these big stocks, they either hoard it for a rainy day, which is fine, the conservative route, or they just buy back more of their own stocks. So they're not going and acquiring new companies. And so when we look at Apple, they announced their earnings last week. They reported a record amount of iPhone sales. And then they said, hey, we're going to work on doing a $90 billion stock buyback. And again, if you know about stock buybacks, they only create wealth essentially for the shareholders. It's essentially like a big gift to shareholders. It makes the quantity of their stock a lot more rare. I read something that I think like 15 years ago, there were something like 23 billion Apple shares, and now there's like 15 billion Apple shares. I could have the number wrong, but essentially Apple has taken about 30 to 40% of their float off the market. And think about that, $90 billion. Think of all of the small innovation companies you could pick up and put under your belt. I mean, when's the last time that you heard about Apple acquiring any significant company? When is the last time you've heard about Facebook buying a significant company? these are all things that were happening, 10 or 15 years ago. But now that these companies are in this, easy kind of cash flow position, and it seems that maybe competition is drying up for each of their individual, sectors. They're just not innovating like they used to, right? I mean, there was a period between 2005 and 2015 where it was like Facebook is buying Instagram, Facebook is buying WhatsApp, Google is buying YouTube, all of these massive acquisitions that shape the companies and the platforms as we know them today. There really hasn't been anything like that in the past 10 or 15 years, and the data kind of proves it. This chart here shows the number of M&A deals since 2010, and they've essentially rapidly declined across all of the big corporations since then. So these corporations, they're hoarding cash, they're buying back their own shares, they're just investing maybe in the tried and true products that work, but they're not creating innovation. And at the end, essentially, when you have this kind of monopoly of companies that are not really investing in innovation, I think you have a hard time really growing your economy. It's through innovation, it's through things like AI, which again, these companies are investing in, that new things get developed, right? Like the biggest innovation or the biggest acquisition we can probably think of is Microsoft buying a little bit of OpenAI, right? That has been, a great pickup for them. But overall, the lack of kind of these M&A deals in the last year, 2 years of these innovation stocks just getting clobbered. And to add insult to injury, now they have to deal with these like high interest rates, venture capital drying up, all that sort of stuff. It's not, to me, a very conductive environment for a healthy and a growing economy. Does that mean that the stock market's going to go down tomorrow? No, I don't think so. But now, essentially, you don't have to keep track of a billion moving parts in the stock market. When you want to see where the market's going in any given day, it's Apple and Microsoft, it's Google, it's Amazon, it's Nvidia. They are driving the entire thing. They are the only drivers at the wheel. Everyone else doesn't really matter. And yeah, that's about it. I don't really share trading positions, but I will give you guys one that I have been building here. But I kind of see sell in May and go away shaping up. I think this whole situation with the breadth of the market and the uber concentration in these stocks is going to become apparent to some people over the next few weeks. And to me, it's kind of a bad sign. So what I've essentially done is I am short QQQ with a stop loss about 2% higher from where we are right now. And my target is that I think this could range bound, because essentially the only bullish scenario for us going higher in the tech indexes is if these stocks just continue to perpetually grind higher and nothing else goes wrong. But it's my take that eventually all these things will catch up. The kind of the fear of recession, the debt ceiling stuff, the regional bank collapses, this uber concentration is going to get kind of sniffed out by the market. And eventually, I just think the money for all of these index funds that are just pushing Apple and Microsoft is going to dry up a little bit. Reality is going to set in. This is my bias. I'm not putting all my money in it, but I look at it like this. I think if you were short QQQ, you can risk 2% to possibly make about 10%. And so I'll zoom in essentially on this so you can maybe see the chart, screen cap it or whatever. But that's just where I stand. That's the only real major trade I have with a bit of conviction, because it has a very clear level where you kind of abandon your thesis if you're wrong, and a lot of room for upside if you're right. So yeah. What else was I going to cover on this? Stanley Druckenmiller, great investor. There was an excerpt from one of his interviews where he was investing in the 80s, and there was a similar setup in the 80s where there was just like a ton of hyper concentration in a handful of stocks. And this is a quote somebody brought up on the chart guys here that I thought I'd share. So it was a combination of a number of factors. Valuations had gotten extremely overdone, the dividend yield was down at 2.6%, and the price to book value ratio was at an all-time high. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. That is, the market's strength was primarily concentrated in the high capitalization stocks, with the broad spectrum of issues well behind. This factor made the rally look like a blow-off. So this sounds so similar to basically what's going on right now. This took place in the 80s. Turned out Stanley Druckenmiller was right, made a boatload of cash. And so I look at history and I say, it doesn't repeat, it rhymes. Could take a risk here, and I think it's a very calculated one in, the most liquid index possible. So yeah. Another thing I wanted to add to this has like a kind of an interesting correlation with what's been going on in the regional banking sector. So if you've paid attention to any of my shows in the last month, you know that regional banks are out, big banks are in, they're too big to fail. Everyone's pulling their deposits out of banks after the whole SVB thing, and they're throwing it in JP Morgan Chase and all these massive banks that guaranteed will get a bailout under almost any circumstance. And it's very reminiscent to me of what is going on in the tech space. Essentially, you just have all this concentration into what is viewed as the no risk scenario, right? The tech stocks are never going anywhere. Apple's never going to collapse. Microsoft is never going to collapse. JP Morgan is totally safe, right? And it just sucks, and it just drains, I think, so much capital and liquidity from the actual economy. Everyone is just piling in into the same trade, the same investment. And meanwhile, in the actual economy in the US, you have about 46% of all employable workers working in small businesses. And those businesses right now, they're not getting the M&A deals, whether they're tech companies or other companies. The M&A deals for these things have radically declined. They have to deal now with 5% plus interest rates. They have to deal with inflation and the demand for higher wages. Half of the banks that these companies bank with are going under now, so they have to, worry about where they keep their deposits. And let's just say you're a big company, you banked with SVB or First Republic, and you got bailed out. You moved to a big bank. Guess what? You want to get your loan for the next, risky thing you want to do. It's not there. And I'm of the mind that I think that credit has been too loose over the last 10 years anyways, but this is an environment that people are not used to. We're going into a very conservative territory, I think, with how people invest and choose to move their money and allocate it. And, whether or not the indexes reflect that eventually is another thing. But to me, what that leads to is this combination of AI and this conservative mindset that's starting to grip a whole bunch of businesses right now. I think eventually is going to lead to much higher unemployment than we have right now. And I'm still of the belief that essentially underemployment or unemployment is underreported when you get those unemployment rates of like 3 or 4%. I don't buy it. There's so many people that are showing up looking for jobs. I'm just seeing it everywhere. Tertiary evidence of just, people not finding good jobs, going on LinkedIn and seeing like 700 applications for a customer support role and something, just little things, right? But that's just my general feeling of it. All this concentration in these big companies and a tougher fiscal and technological environment to really get ahead in life. To me, it's not a great situation for the markets, but they wouldn't call them markets if it wasn't for us having our own opinions. So I'm curious what you guys think. If you think I'm totally off base here, let me know. Next up, we'll dive into the quickie news after a quick word from our sponsor. This week's show is brought to you by Beaver Bitcoin. Dollar cost averaging is the most stress-free method to enter the Bitcoin space. And if you're looking for a simplified way of buying Bitcoin in Canada without needing to rely on a custodial exchange, Beaver Bitcoin is your best bet. Beaver Bitcoin lets you set up recurring Bitcoin purchases directly from your Canadian bank account and straight into a Bitcoin address that you control. It's like a savings account in a currency that you actually want, or a Netflix subscription that doesn't suck. And if you don't want to wait to stack sats, Beaver Bitcoin supports instant non-custodial Bitcoin buying via e-transfer as well. Give it a shot today at beaverbitcoin.com. All right. So, quick news. What else happened this week besides complaining about companies getting too big? Elon Musk finally decided to stop being the CEO of Twitter. So he's hired this woman named Linda Yaccarino. She is a former ad executive at NBC Universal, which kind of drew a little bit of ire from the free speech crowd on Twitter. It seems like she's part of the elite caste, maybe from the World Economic Forum. But she will now be running Twitter, and Elon Musk will now be kind of the head of the product there. Curious what you guys think. I think Twitter's relevance to me, it's really fading. I think there was an article I was going to bring up, but Jack Dorsey is launching his own new social media platform that's like open source and all that, called Blue Sky, but it's an invite-only thing, and it's really seen its numbers pop. I don't know if it really competes with Twitter, but it is Jack Dorsey doing another Twitter-esque platform, so who knows. Another thing, I'll post the link to it. I don't think I posted the link in the description. There's this guy on TikTok named Millennial Moron, and he is coming out with all the spreadsheets and facts about how ludicrous it is to invest in real estate these days. I think we've kind of known that, but apparently a lot of investors do bad math. And so they're going out to Toronto and they're buying these one-bedroom condos for $699 or whatever. And they think they can make free cash flow. And they think even if they don't have free cash flow, you know, the value of the equity will rise enough to cover it. And he does this amazing job in about 2 or 3 minutes of breaking down every line item of what it's like to earn real estate. And he perfectly, to me, encapsulates why I haven't gotten into real estate, besides having all my money tied up in Bitcoin. But it's just the sheer amount of maintenance and fees that come after you buy a property. And to do it as an investment just does not make sense financially, where rates are, you know, 4 or 5%. Totally nonsensical. And he does a great job of breaking it down. So I'll share that after the show in the description. Someone remind me if I don't. This was an interesting article I saw here about a company adopting AI for its chatbots. And so essentially, I'll summarize this, is they didn't just fire everyone in their customer support team. They got AI bots to essentially shadow the top performers and kind of the entry-level performers in the customer support section of their business. And they learned some really interesting things about this. And essentially it was that the chat bots were not really able to outperform or assist or improve the productivity of the high performance workers. What they would do is they would look at how their conversations went and they would mimic them. But they found that using those chat bots really helped aid and teach the lower performers. So essentially the chat bots in this situation, the AI in this situation, helped kind of take the high level performers and turn it into like take their cumulative knowledge and then turn it into little mentorship bots for the low performing workers, which I think is really interesting, because I know that, you know, the consensus view of these things is that, oh, the chatbots are going to replace every human. They can have human-like functionality and all these things. But I think that there's certain things about human behavior which is going to tick some people off and will help people kind of see through kind of the guise of some of these AI bots. One of them is that, you know, some people on support lines are just super abusive, right? And so as a human to a human, you have to kind of figure out how to react to that. But robots, you know, they will never be aggressive. They will always be passive. If you've ever sworn at Alexa or Siri or Chat GPT, it says, "I'm sorry," and then it'll like kind of panic and try and get you a new answer, right? So generative AI, while I think is coming for these roles, will in the meantime serve some other functions besides just straight up replacing people. And then eventually we'll see you know, how successful and how productive those AI bots can be versus the top 1% of customer support roles. So yeah, interesting article here. Again, we'll try and share this after the show. This came in legitimately 10 minutes before I went live, or an hour before I went live, but I saw it 10 minutes before I went live. Binance is officially pulling out of Canada. So I've had a feeling this would happen for a while. I'm surprised it took as long as it did, because I was at a blockchain consortium probably about 8 months ago, and there was a person from Binance there, and they were trying to work with the Canadian regulators to allow Canadians to do things like futures trading and have the platform and all that. And Canadian regulators have just said, if you have anything to do with stablecoins, you're banned in Canada. There's no exception to that. So nothing to do with Tether. They really want to wash their hands of any stablecoin stuff. And essentially, Binance could not find a way to get Canadian dollars on the platform. It would just segregate that market way too much, and it's not worth their capital to have to create an entire new Canadian platform for, you know, 30 million customers. So they had all this team lined up to get Binance rolling out in Canada, and the whole thing fell through. And I kind of had that feeling back in October of last year that it would, because the guy I spoke to about it was just not that enthusiastic. And so eventually it comes to this. Here we are. If you're a Binance user, you have until September 30th to close out all your positions, your staking, what have you. Take all your funds off and keep them in a cold wallet or find another place to trade. But to be perfectly honest, it's a bit of a nightmare trading in Canada. The liquidity for the Canadian exchanges and pairs is just awful, especially anything outside of Bitcoin. So, you know, I've worked with a couple companies like BitBuy in the past and Virgo and all these things, but it's like, it's not for serious traders. So what I recommend is if you are Canadian, you want to keep your trading activity up, even though the Canadian government doesn't want you to, invest in another passport, maybe number one, but also look into some of these decentralized DEXs and really decentralized ones, not just ones that say they're decentralized, but still comply with US regulators and all that stuff. Yeah, kind of a big deal for sure. Second piece of Binance news is that Binance US is exploring ways to cut the founder's majority stake. I think very soon Binance is going to be banned in the US as well as Canada. So yeah, we're just being protected, folks. They just want to protect us from another FTX, which they totally saw coming in the first place. Just needed more regulation, right? Another thing, let your opinion be heard. The Canadian government is doing some testing of the waters to see about a central bank digital currency. So what is a CBDC? It's Canadian dollars, but it's not cash. It's digital and it's issued by the central bank. And so in the future, they want to create an app that lets you have Canadian dollars without you having to have a bank account. But anybody with half a brain knows that this is just a fancy way of having extreme surveillance and coercion technology for controlling what we spend our money on. So just full transaction oversight. And they have a survey, so you can let them know your opinions on that stuff. Maybe you believe me, maybe you don't. They break it down in the poll, in the opinion survey. But I don't know, give it a look. Put your opinion in there. Digital form of cash in your wallet. But we all know eventually in our lifetimes they are going to try and get rid of cash, because cash is the only way of really doing fully private transactions that are not traceable given enough due diligence. And so Big Brother doesn't like that in the long run. And so expect that to go away at some point. Lastly, clip of the day, clown word clip of the day. So this is Congressman Brad Sherman at a U.S. House hearing. And essentially, he is the most anti-crypto congressman out there. He thinks it's all a scam. It's a bunch of drug dealers and whatever, and America should ban cryptocurrency. This is his take on the crypto bros, but pay particular close attention to the last two words of what he says, or the last sentence of what he says.
Crypto bros make money literally by making money, and they've made over $1 trillion out of thin air. They'll accuse the U.S. government of making money out of thin air. Maybe we do, but we're the U.S. government. Crypto bros.
We're the U.S. government. Yeah, there you go. Saying the quiet part out loud. We're the U.S. government. We can print money out of thin air. We're allowed to. You're not allowed to. And you're not allowed to try either. You stupid plebs. My God, you in the cryptocurrency space, you're always trying to innovate and provide financial access and inclusivity. Well, go screw yourself. This is the U.S. government. We take care of that, and we control the issuance, and we control the supply. And if you don't like it, you can go buy the euro. I don't know. I just think it's crazy when people say things like this. But, you know, everyone's true colors are showing these days. You kind of have to love it at the same time. All right, last article of the day. I'll make this one quick. The White House is putting a Bitcoin mining tax in. I don't remember if we talked about this, but essentially the White House came to the amazing conclusion that Bitcoin miners are destroying the grid, emitting all this pollution, and we need to tax them to discourage that. Not outright ban, because, well, we can't. Freedom of speech laws actually probably protect Bitcoin more than anything. But we can tax it into oblivion. And Nick Carter here writes a really good article as to why it's a really silly precedent to set. And so I'll give you kind of like a bullet point summary of this article. So essentially, in its bid to marginalize the domestic crypto industry, the White House has unleashed financial regulators, deputized the banking sector, and generally harassed crypto firms here. On top of that, they're looking to pass through a de facto ban of mining in the U.S., with a levy that would add 30% to electricity costs for miners, which would turn their economics upside down. It's an extremely dangerous precedent, as it singles out an industry that lawfully purchases electricity, holding the electricity buyers responsible for the carbon emissions of the underlying generation. This makes no sense. It's not Bitcoin miners' responsibility to decarbonize the electricity they purchase. That falls to the architects of the grid. If the Biden admin can't get the grid to be sufficiently green, it should focus on that rather than punishing an industry that buys less than a single percentage point of the electricity produced by the US in a single year. And if that precedent is set, taxing an unsavory industry for ecological reasons, let's just say, any politically disfavored energy consumer will be potentially in the crosshairs. And you can easily imagine that a energy tax could be levied on AI models that aren't sufficiently woke or providing misinformation, or data centers running servers for uncensored social media. And on the flip side, if there's like a right-wing government, they could use this same kind of force to tax abortion clinics on their use of electricity, essentially allowing the government to regulate commodity usage and kind of pick winners and losers in that space. So yeah, it's kind of ridiculous, this whole thing. They think that it's going to raise $3.5 billion over 10 years when it really wouldn't. All crypto miners would leave the US pretty quickly. It would get miners to pay their fair share of the costs imposed on local communities and the environment when they're subject to the same tax regulations as any energy or financial company would be. But indirectly, it would actually increase the emissions associated with Bitcoin mining, because all it's going to do is just push those miners to different jurisdictions. There's tons of places all over the world. We learned that last week, Kingdom of Bhutan, who would love to host Bitcoin miners. Come to my country. I got cheap energy, right? There's no competitive mode in the US, right? Bitcoin just goes wherever there's cheap energy. It doesn't care that it's on Freedom soil or it's in West Texas or New York State or whatever. It doesn't care, right? So it's only going to go where it's economical. And as soon as you put something like this down and you pass something like this, every other country starts to salivate. Like Russia probably loves it. Yeah, go for it. Go put this mining tax on. Like we'll take the miners off your hands. Like either the businesses can come direct to Russia, or if you guys fold, you can just sell us your machines for dirt cheap. And he makes that point here. It would directly empower America's adversaries like Russia, China, Venezuela, and Iran by making state-sanctioned mining operations more profitable there. And it would eliminate the ability of Bitcoin miners to help monetize the renewable build-out in the US and rule them out from assisting with grid stabilization programs that they actively participate in. And this is a really key point, and I never feel like I have enough time to fully explain this, but when you move into renewables, you have all sorts of excess electricity. And if you don't have anything to do with that, number one, you have to build infrastructure to divert it somewhere else. You have to use it in some sense, or you just have to shut off the machinery that's generating it. This becomes a massive problem, especially in solar districts where they're doing nothing for maybe 12 to 8 hours of the night. And they're overclocked in places where it's extremely sunny and there isn't peak demand. Generally, when it comes to electricity usage, most people consume the most electricity sort of around the time they get home from work. It's that time between like 4 and 9 p.m. Where there's peak electricity usage, and that is not peak electrical time for solar. It's very much the opposite. Peak electrical time for solar is usually between about 12 to 5 p.m. almost anywhere in the United States. So the big point that they're trying to get at with all this is that Bitcoin miners can use that electricity whenever, and they can shut off. They don't have to run 24/7 if you don't want them to. But if the price of electricity is right, and it certainly would be, then they can help in basically subsidizing the build out of solar. So if you have a buyer of that excess solar between 12 to 5 p.m., then it makes it economically feasible to start building solar plants everywhere, right? And it helps with some of these more intermittent energy sources and helping them be affordable. But you scare them out of the country and you don't have that capability, and there's no real way to capitalize on that excess solar with any other energy source. Like you can't run data centers extra hard between 12 to 5 p.m. This is a solution posited by a lot of people. Like, well, who cares if Bitcoin is using renewable energy? It could be used for something else, like data centers, right? Like there's no peak load that data centers can just consume, peak computing activity, right? So it's all silly. When you scare out Bitcoin miners, you're really scaring out an innovative technology that can help stabilize and incentivize renewable energy. And you want to ban it? Go for it. They are well on their path to doing that. And yeah, I just think it's silly. But alas, it's good to understand and know these things. Yeah, and that's it. That's the show for today, everyone. Let's dive into the chat and see what you guys are talking about here. Let's pop it out here too real quick. All right. 57% say stay a baby, but that's on 7 votes. There's only 1 vote more. If you're watching this show, you have to let me know. Do I keep the beard or do I stay a baby? Or do I grow the beard or I stay a baby? We'll see. My big thing is that I always can see my double chin when I don't have the beard. I feel like it kind of covers it up a little bit, but maybe that's just like more of an incentive to get fit and lose weight, hopefully, which I've done. I've lost a little bit of weight in the last few weeks and months. I'm proud of myself. It finally happened, but enough patting my own belly. Saludos a Romero que está viendo. Oh man, I saw you at the program from Toronto. My Spanish is so bad still. Beard, just be you. I don't know. I like the lack of maintenance you need when you have a beard. You need some maintenance, but it's like more to keep kind of like shaved, I find. Mikiko likes the stubble. She's going to be the most important voice in all of this because she has to deal with that every day. It's always the lead generals that get hit last as the flight to safety stocks can't hold up. Yeah, there's like a term for that, like the killing of the generals or something like that. The thing is I just don't think these things like fold in a spectacular fashion. I think bears in the market, they always need a liquidity event to get momentum. So they need to have a shock to the system. That's why I think 2022 was such a rough year, because so many people didn't see it coming. But everyone kind of knows we're going into a recession, and I think that's why the market has just consolidated into these guys rather than freak out about some pending doom. It's really these knee-jerk liquidity events. Maybe the SVB collapse, you could call one of them, but I mean, the market shrugged that off really quickly. But yeah, you kind of need these, I don't know, big sucks, these big sucking noises in the market to pull money out, because otherwise the funds just passively invest and they're just going to pick the winners, and the winners lift the whole boat up for everyone else, and they get more concentrated and they get more and more concentrated, and it makes the smaller stocks not matter really what happens. They just don't have an impact on the market. So it really isn't until you get like a global phenomenon where people just need more dollars right away that you're going to see the markets tank, because in order for that to happen again, people are going to have to want to sell their Microsoft and sell their Apple because they think that something else is more important than holding those stocks. And I don't know, you're just going to have a hard time convincing most people to do that. Just got in a little late to catch live. We'll watch right after. Have you covered Ordinal's meme coins? No, I haven't, but I'll give you my opinion really quick on the Ordinal's BRC20 thing. So for those who don't know, the fees to send Bitcoin are kind of like a free market thing. If a lot of people want to do it, they cost more in fees to send your Bitcoin from A to B. And if it's not that busy, it goes down. It's just a free market for actually sending the transactions in Bitcoin. And generally for the last like 3 years, if you want to send a Bitcoin transaction on the base layer, it's cost you like 5 to 25 cents, really dirt cheap. And everyone was so happy about that for the longest time. A couple people have found ways to essentially inscribe financial transaction data on the Bitcoin blockchain. You can upload images onto the Bitcoin blockchain, and since there's kind of this belief that Bitcoin is going to outlive all of us, that sort of has a bit of an economic value to it. Like, what if you could upload a will, or what if you could upload a meme or a picture of someone, and that could be stored in every single Bitcoin node around the world? It's kind of sparked people's imaginations over the last few weeks, and that kind of hit a fever pitch in the last few days, because some people figured out, you could also create your own altcoins through this mechanism. And so it just rushed a ton of speculators into driving up the cost to get your transaction into a Bitcoin block. And everybody's kind of pissed about this in some way or another. Some people are like, it's a free market thing. All the Bitcoin maxis want to get rid of it. And then the hardcore Bitcoin maxis are saying, we shouldn't have let this happen in the first place. This is a problem with Taproot. blah blah blah. But essentially, I'm in the camp that it's a free market thing. The Bitcoin blockchain has this in it, and if we don't like it as a community, we can vote through consensus mechanisms to roll it back. I just don't think that there is enough support on either side to have a winning hard fork in the situation. I think a big chunk of the Bitcoin community supports this. Michael Saylor said he kind of supported it the other day. So a hard fork to me, I don't think is going to be on the cards. But my other side and the less interesting side of all this is I just don't think this stuff will stick too much. Because number one, the token minting mechanism of ordinals just doesn't make economic sense. It's a pain in the ass to transfer these things, and the only reason you would make tokens is to sell them to the next sucker. Well, guess what? Every other blockchain is way more efficient at doing that, and people are going to find that out really quickly with Bitcoin. You can ascribe images and all that stuff, and I'm sure that has economic value, but ultimately I don't think that's going to over congest the network. I always think that, if you want to inscribe a picture of your dog or a will for eternity on the Bitcoin blockchain, there is going to be a market for that. That's going to help rise fees, but I don't think it's ever going to create massive congestion on the network in the long term. I think you're going to get little blips where people kind of find this information and try and use it to their advantage. But I ultimately think when it comes to speculation and some of the more interesting things you can do, all that's going to move to layer 2. And so we've always known as Bitcoiners that fees have to rise on the Bitcoin network. They can't just stay at 4 cents forever because the block subsidy will go down, and then the network security is just not going to pay out enough. But I think this whole thing has been a good wake-up call for people in the Bitcoin space to value block space a little bit more and not to take for granted the fact that we've been able to send billions of dollars across the world for 4 cents at a time. That's just never really been realistic. It's not going to be like that certainly in 100 years. We should just get happier for all the Bitcoin miners that are making some extra money this last week, and know that industry is going to be around for a while. It's cool that people are waking up and appreciating block space. And Baptiste, like you've said, I think it also creates some urgency to scale the Lightning Network and layer 2s and all that. 2 companies that I've worked with have said, oh yeah, we're going to be doing some more Lightning stuff this week, which is awesome. The worst part about Bitcoiners that I find as a culture is that sometimes we get really complacent. We think that we just have the answers for everything, that we figured it all out, and that Bitcoin is inevitable. No, it's like the worst. That is the worst mindset to have when you are innovating on a new technology, that you figured out the keys to everything. You want to have that sense of urgency. I think we got that this last week in the Bitcoin space, and I think that's awesome. And I think it's also going to bring more capital into the space too, as people see a demand for layer 2. So it's a win-win-win-win-win, I think. It's a good wake-up call, and we're all going to end up better because of it. But yeah, thanks so much for tuning in, guys. That's the show. Don't forget to give the video a like if you haven't. Helps it reach some more people. I love bringing these to you every single week. I'm going to try a new format either next week or the week after through Streamlabs, so you guys, while you're watching the stream, can see comments pop up and maybe I can respond to them. We're going to try something new. It might be glitchy, but I want to interact more. I don't like having all the comments just at the end of the show. It'd be cool to have them kind of during, and also maybe bring in a co-host or two. So working on that for next week or the week after. And stoked to see how that turns out. Thanks so much, everyone, for watching. Take care and have an awesome weekend.